Right. Hi, everyone. My name is Ruslan, and today I'm going to be talking about AI in quantitative trading. So yeah, just a small disclaimer. I'm going to be using sources that are publicly available. It's not an investment advice, obviously, purely for educational purposes, and I'm representing my own opinion and none of my current or former employers. So rough plan for today, we're gonna look at financial market data, problem of price discovery, roles that are common in the industry, speed versus accuracy trade-offs, and advanced modeling in the field. So does everyone know what quant trading is? Like, could you give me what comes up to your mind when you hear this two words? Anyone?
Trading using quantitative models.
Yeah.
Is it connected with high frequency trading, or am I imagining something completely different?
Yeah, good hunch. What else?
Trading using numerical methods.
Right.
Quantitative data informed trading decision making.
Very good.
Close.
Yeah, it's all works. Maybe some forex trading comes to mind. I don't know. Anyway, it's good. Yeah, good suggestions. Does everyone know? So this is the price of an asset over the 5 years of time. Does anyone have a hunch what asset this might be?
Video?
No.
Hand gel.
Sorry?
Hand gel.
Hand gel. No.
It's the I don't know, the one you use in hospital, a safe, and you can turn into water. That one.
No.
No.
All right. Yeah, it's just the price of Bitcoin. I don't know how many investors in Bitcoin are here today. Obviously, yeah, it went up almost 10x in the last 5 years, which may be a good joy or disappointment for people. But yeah, so what you see here is basically the price at the end of every trading day. So it's the final result of the process of price discovery, demand versus supply negotiation. But I'm going to be talking about what lies behind that in more details. Like, it's much more complex underneath than just like a line that represents the price dynamics. So this is actually what is going on inside the exchange. This is the limit order book. Has anyone heard that term before? It's basically the green is sort of whoever wants to buy this asset, the red is whoever wants to sell, and this is sorted by price. Obviously, the higher buyer, the buyers who want to pay higher price, they are closer to like getting traded. Same for the sellers. So the difference like between the highest buying price and the lowest selling price is the spread in the market, and when the spread becomes zero, basically a trade happens and a particular asset changes hands. So yeah, as you can see, this is quite not very obvious where the price is gonna go, and there's a lot of orders, a lot of people wanting to buy or sell with different intentions, and so on and so on. So how do we sort of come up with a fair price of of that asset, and how can we make sure that it's priced fairly. Basically, this is what quantitative trading is about. Generally speaking, the industry has settled on 3 types of strategies that make economic sense. Arbitrage, so basically if kind of the same thing is priced at different prices at different places, then it's called an arbitrage. So say there is an ETF on S&P 500 that you might be buying for keeping your life savings in. So obviously it consists of a basket of 500 stocks. So sometimes it happens that the ETF is just one security. It should ideally track the combined price of these 500 constituents, but sometimes it's not true, and that's when the arbitrage opportunity arises. Market taking, basically, whenever someone knows that the price should be higher or lower for a particular asset, they can buy or sell that asset, informing the market about where the price actually has to be, and sort of getting rewarded for doing so by sort of say they predict the price will go up, they buy low and then they sell high, sort of the what everyone in trading wants to achieve. And another one is market making. So basically, say you want to buy, again, like in the previous example, an S&P 500 ETF, somebody has to be willing to sell it to you. So these counterparties are usually market makers, so they are connecting buyers and sellers through time, thus taking on risk that the price of this asset can go up or down in the meantime. So where does the edge come from usually when doing this type of business? Sort of one is more like old school type of edge is the infrastructure. So it's like back to this high frequency trading. People have perception that it's all about the speed game, and people are just like competing by building massive data centers and plugging in cables into the exchanges, which is kind of true. But lately, also the other one, like modeling, so forecast accuracy is becoming more and more relevant with the most recent advances in machine learning and AI. You no longer have to be the fastest. You can also try to be a bit smarter. Then you can afford losing some speed advantage. So what are the benefits of quantitative trading? I believe usually, the perception is that people are making money from thin air. There are movies about this, and a lot of people think that it doesn't really contribute anything significant to the society. But it's not that simple overall. One benefit is tighter spreads, so sort of the difference, the minimal difference between a buying price and a selling price tend to converge as a result of quantitative trading activity. So meaning that, if you want to buy something now and then maybe immediately sell it for some reason, or like sell it very soon, you're not going to lose much on that price difference. It also propagates information across the globe. So say people in Europe, it's now the night, people are sleeping, but it's now morning in Asia, and say gold is trading both in Europe and in Asia. Then say now more economic activity is in Asia because it's daytime. People buy and sell, and then it takes some time between that information propagates to Europe, say. So let's say somebody is buying a lot of gold in Asia. They're inevitably moving the price up, meaning that momentarily there is like a difference in price of gold between Asia and Europe, which is obviously not great. So participants in this industry, they contribute to faster convergence and kind of aligning the prices across the globe on the same things. And overall, it facilitates smoother capital flows in the economy, like, basically connects buyers and sellers, allows people to buy and sell securities cheaper, store their pension savings, etc., etc. So overall, it's good. Then somebody might remember that there is such thing as efficient market hypothesis in science. So basically, who has heard about it generally? Yeah, so quite some people. So yeah, basically that hypothesis in science, it says that the markets are kind of efficient. So it means that ideally there should not be any mispricings or arbitrage opportunities and so on and so on. But then we also see those headlines like the ones I've collected on this slide, like a bunch of major trading firms like Citadel Securities, Jane Street, Hudson River Trading, XTX Markets. They're like banking quite hefty profits. So you may wonder if the markets are efficient, where does this money come from? So science is good, but the thing is that the markets don't become efficient automatically. It's all by the virtue of these participants, like these trading firms, that their activity converges the market towards more efficiency, but they don't do it for free, and they get compensated for the risks they take and for the activity they do. Going to some kind of AI related topic, like one of these firms that I mentioned on the previous slide, XTX Markets. It's quite impressive how much compute power they use. So that's taken from their website. They claim that they have like 25,000 GPUs. So you can see that, this industry is very computation heavy, and like most likely the modern AI methods are very applicable, and a lot of research is being thrown at it. So generally these firms, they don't publish papers or like disclose their know-hows, so we cannot really say what exactly they are doing, but given these kind of side science, we can judge that, most likely they are doing the most cutting-edge AI research. And actually, a fun fact about XTX Markets, they this summer they created like a PhD, like a program for recent PhD graduates, and they pay 35,000 per month to those who get hired. But it's obviously very competitive, and they are looking for the kind of brightest minds in AI to drive their research efforts. So roles in the industry, like who are these people who make the markets efficient? Like it can vary from firm to firm, but generally you can find people who call themselves quant researchers, quant traders, and software engineers in these firms. So quant researcher is more like doing modeling, doing data analytics, writing research software, basically creating forecasts, etc., etc. Quant traders are quite similar, but a bit closer to perhaps doing actual trades based on all this research. Software engineers, obviously, yeah, someone needs to build all that software that runs for 24/7 and that runs on high speed, very reliable, parallelizable, and so on. I have some links, so if anyone is interested, you can read more about it. So what kind of machine learning problem is actually being solved in quantitative trading? So the most obvious is future price forecasting. So say you wanna predict where the price on a particular asset will be, like sometime in the future. So the problem is it's like not that simple, obviously. So what is sort of y and what is x in this machine learning problem? So you can say that potentially y is like the price and steps ahead in the future, but like what is a step? You can think maybe it's like next second, next minute, maybe next day. So it's not easy to say, obviously, and like generally, say it's fairly easy to say where the price will be like next millisecond or like next second. So there's higher signal to noise ratio, but the further you go ahead, the lower that signal to noise ratio becomes, and it becomes really hard to forecast something sensible. So that also like, say obviously let's say if you want to predict next second, then you have to be very quick to execute on your forecast. Otherwise, yeah, it will be gone and you won't be able to get it. So it's natural to say that, okay, I want to predict maybe 1 hour ahead, but then the signal to noise becomes so low that it's also like hard. And what is X in this problem? Yeah, usually you have your market data, like similar to what I showed at the beginning, all these tables with bids and asks. You can use those events to base your forecast on. You can look back to see some history. You can do some aggregations, etc., etc. Then say okay, you finally solved somewhat. You know what you're predicting. You know what data you're using. How you're gonna act on it. You can say that, yeah, it's as simple as if I'm predicting the price is going up, I'm gonna buy. If I'm predicting the price going down, I'm gonna sell. But on a micro level, a lot of challenges come in. Like as I mentioned earlier, there are spreads. So every time you want to buy or sell, you pay some cost. Also, if like someone is buying stocks or selling stocks or crypto in their like personal account, you might see that there are also fees that you pay every time you do a transaction. So say maybe you want to buy like one share of Apple, and maybe you are forced to pay like $1 to do so. So that means that not every time that you're predicting the price is going up, you're gonna actually buy, because sometimes it can be a bit too costly to do so. Then there are also problems like probability of getting that trade. So if it's like safe to assume that you're not the only one who knows that the price is going to go up, so you're gonna be in competition with other counterparties to get filled on that trade. Some more like technical Q positions, so also related sort of to probability of fill. Like say many people know that the price is going up, they start queuing on a particular price level, and then probably those at the end of the queue, they won't get traded, although they were correct about their price forecast. Also a bunch of things that can go wrong. adverse selection. So like a classic example from a textbook is about buying cars. So say, you're like buying a used car and the dealer agrees to sell it to you at the price that you wanted. And you're like walking away very happily, but you don't know exactly how is the car actually, but the dealer does. So it might be that, they were willing to sell it to you just because there's something wrong with the car and you thought the price was good, but in fact it's not. So same thing happens here in the exchange. If you want to transact, then there needs to be another party who is willing to be on the other side of the trade. So basically the probability of that trade being good decreases when you actually condition on being traded. You can also cause market impact. So you're like so big, you're accumulated such huge position in this market, and then like there's, for example, nobody else willing to take the other side of it. Also, a huge thing is information leakage. Say you do know where the price is going, but once you start showing your intentions to trade, other people can also observe this and they can figure out that, if that guy is he started queuing in the order book, maybe now, I'm also gonna do that because if that guy is doing so, probably he knows something about the market and some signals become just too crowded to trade on because of that. So let's dive into the topic of AI and deep learning perspective here. So some people would say, to solve the market price forecast problem, just throw a transformer at it, and just let it sort out everything. Say a new event comes in, your transformer just looks at whatever is relevant in the past, some similar events, and just throws out a prediction. It's great for long context. It's nicely GPU parallelizable. But the downside is that the training costs are kind of quadratic, and your inference, it happens linearly. So we get back to the problem of being fast versus being smart. You cannot afford to lose too much time on your forecast because the opportunity will go away. You can see some recurrent architectures as well. So they are very fast for inference. So you do a couple of matrix multiplications on the inputs and the hidden state vector, and then that's it. But it's bad for long context. So when working with markets, you may want to know the past events, but with these architectures, the information gets compressed and very, very quickly. And also, since the signal-to-noise ratio is so low, also the way you are updating your hidden state gets sort of corrupted at the end. And they're sequential and not very GPU parallelizable, although there are some improvements on that front in state space models. You can also look into reinforcement learning, and a lot of people actually think of trading as a perfect problem for reinforcement learning. But the problem is that the markets just don't behave as what we wanted to behave to apply reinforcement learning. There are no good simulators. The dynamic is not really stable. The environment is adversarial and non-stationary. The market impact is very hard to model, so it's also not very ideal. One interesting approach with the CNNs, for instance. like on the left side, you can see in green and red just the representation of an order book, like similarly to how we saw it before. Like what if you just let like pass this image over to like a CNN and let it decide for you. So there is like an interesting paper. I put a link here. So they are like you can use that RGB kind of images, but it's like not ideal because obviously like the price moves, and say sometimes the price moves up or down as much as like it never comes back basically. So the environment is quite unstationary, and and with this RGB you would need like 3D tensors to store it, so the model is going to be a bit complex. So the authors of this paper, they suggest to like normalize your images. So like instead of using non-stationary order book representation, they try to normalize the order book in relative terms. So they benchmark all the prices against the current, say, bid price, and they represent it as just grayscale image in the center. And also, like, you can combine like multiple events, as you can see on the right. And this is quite nice. What's good about CNNs, basically, you don't have to do manual feature extraction like with all like other models. A lot of people, the industry generally was very reliant on manual feature extraction, like scientists, researchers, they were sitting like the whole day trying out different features, optimizing their parameters, hyperparameters. So this does this for you. And also the convolutional kernels, they can capture quite nicely the relationship between like adjacent limit order book records, which is nice. So you can kind of combine different events in time and let it to figure it out. And in this paper, they just classify basically whether a price goes up, down, or doesn't move much. And they claim that it beats the previous approaches that were discussed in other papers. So it's a bit hard. So given like what I've said, it's a bit hard to kind of there's no like silver bullet. There's a lot of research involved. How you even state the problem, what data do you use, how long you are predicting for. So all these tasks people solve in the industry. There's a note here, like, a lot of people, they're like closely monitoring something like how far ahead you're predicting versus like your error rate. So obviously, if you want to predict very far ahead, that's kind of better because you don't have to act very fast, but also your forecast accuracy goes down. Simply said, if you could choose to be very dumb but very fast, that would not be the worst choice to make. As you can see here, like the very very short-term horizon, like still kind of ends up in the money, and some of the very longer-term strategies, they fail to make money basically, although their forecast quality is not that bad. Just to give you some color on how fast the participants can be. This is a slide from like I believe Eurex. It's like one of the biggest European exchanges, and they published some research on the reaction times that they're observing in the markets. And in this particular example, you can see that there are like 10 participants that react within like basically 3 microseconds. So that can give you some color on how fast the top participants are. And for those who are willing to like try out something and see whether they want to become quant traders themselves, there are actually a bunch of competitions where the trading companies upload a data set and they formulate a problem for you. So even though the industry is quite closed and not very open to like sharing, some things you can still like you can still get some hands-on experience if you're interested. And I put some historical competitions here, but also 3 of the competitions are the ones that are still live now. So for those who are interested, that's a wrap, I would say. So if you have any questions, happy to answer. Yes?
Thank you for the presentation. Just a quick question for me. Personally, I'm not an expert in quantitative analysis and all that. But what does the learning curve look like for someone new getting into it? Both from theoretical part to the technical aspect, software engineering, and also I think you made a reference to deep learning here and all that. Does that make that easier now to get into this field? Or do you think the learning curve is still kind of steep?
So generally I would say it's most common to see people with STEM background, so like science, math, statistics, physics in this field. Like you're expected to know some basic math, probabilities, machine learning on the start. Also, you're expected to know how to write decent code, like not very good, but at least like on a level that it runs. So like I have here, if you're very interested, I recommend checking this link over here. It breaks down a lot about like how to break into this field, what is the kind of what you're expected to know, what you will learn. Like the space is quite narrow, I would say, so there's not so many roles that are open, like definitely much less than like in big tech industry, but it's growing, so it's expanding over the years. But it is fairly competitive to get in, and you have to stand out in some way. If you're like an expert in machine learning, deep learning, and AI, I think that's quite valuable, but you need to kind of be able to prove it somehow. Maybe you win some deep learning competitions, or maybe you have some nice projects that you've completed at home. So yeah, that's definitely a very valuable skill to have to get in.
Cool. Thank you. I think you answered my second question in between, actually.
Nice.
It was more about the machine learning aspect, the deep learning and all that. So sounded more like one is to be some sort of expert, because I was going to ask about the community, right? But some of those models that you'll have to train, looks like, do you have a couple of open source versions of this, or you have to train your own model, like build everything custom yourself to work sufficiently? But if the community is narrow, then I guess
Yeah, I would say like if something is completely open source, most likely it doesn't work because everyone operates in the same markets, and if something works, then you can trade based on this at home, and sort of it gets arbed out very quickly. So yeah, that's why everyone is putting a lot of effort to develop something customized and do a lot of research to see what works best for their particular method of trading and become better than the competition.
Thank you.
Yeah, can you start here? Yeah, because microphone's here, sorry.
Oh, okay. Yeah, I was rather impressed by the slide of the 3 microseconds. I just wanted to understand in that context, what does it mean reacting into 3 microseconds and reacting to exactly what? Like, what is the event and what is likely to be the reaction? What does this mean, all of this in the context? I was curious to know because 3 microseconds is such a small amount of time in which you cannot do anything, essentially.
Yeah. Yeah, good question. So what they react on is basically it's some signal. So you kind of know that the asset is mispriced right now, and you wanna close up this inefficiency. So say you know that Bitcoin is gonna go up by $10 in the next second. So you wanna buy now and make this $10, like pocket this. So usually, yeah, there's a bunch of signals. Like that's sort of the secret sauce. Everyone is looking for the signals that work for them. Like one of the signal, which is quite obvious, it can be like Bitcoin is traded on multiple exchanges across the world, and say, yeah, and this like going back to this like Eurex example, I believe there's the same asset trading on two exchanges, and then like you kind of know where the price discovery happens is basically like on one exchange, more people trade, the asset is more liquid on that exchange, so you kind of assume that the price discovery happens there, meaning that if on that exchange is leading basically. So if it went up on that exchange, then you know that most likely it will go up on another exchange, and that is a simple trigger that you can react on. And yeah, people tend to do it in like sub 3 microseconds. How they do it? There's different techniques. It gets quite funny actually. Like very common is like being co-located with the exchange. So basically your computer is like plugged in with like a physical cable into the server where the exchange is hosted. Yeah, sometimes people like build microwave towers to like send those signals very quickly, say like gold trading in London or gold trading in like Chicago. Say Chicago is leading, like you wanna send that signal through the Atlantic like as fast as you can. Sometimes it becomes even funny because like someone builds a microwave tower next to an exchange to send these signals quickly, and then like sometime later somebody else is building another microwave tower in between the exchange and the other microwave tower to block that signal so that the other microwave tower doesn't get it. So yeah, it's been like this arms race for a while. Now I think, yeah, that space is very, very competitive, and that's why people actually are looking into AI and like stuff that is like more tolerant to like higher latencies.
Thanks. Can you go just clockwork?
Do we have time?
Yeah.
Okay. One meta question. Are these slides going to be somewhere so we can follow your links?
I guess.
Yes, so I guess like the best way would be like I will put the links to slides in the meetup as the first comment, and like they also will be like in our social methods, but justified. But as well, like they're going to be a video, which I also add like as a next comment after it, where you can see the same like we've seen here, and like with links, with slides, and everything over there.
Cool, thanks. So, right, actual question there. So, one of the things that's always struck me about like financial prediction is that literally almost anything in the world could potentially be a signal, right? A feature. Like the stocks could depend on the weather, social media, news, all sorts of things. So it seems to me almost like the ultimate feature extraction, feature selection kind of problem. Can you say anything at all about how quants, as you call them, decide which of the infinite number of possible features to actually use, or is that way too proprietary to give me any clue at all?
I mean, yeah, like one easy way is like the one I mentioned. Yeah, you just let the neural network figure it out.
But in this case, like your convolutional example, if I understand it correctly, the input is just the market data itself, right? I'm more curious about everything external to that.
Yeah.
This is obviously easy to, convenient in a sense that it's easier to work with, like it's inside the system. But what makes the financial system interesting is that it's perturbed by all these external things.
Yeah. I would say, people usually they like quants, they have to have some bias towards like what can be helpful to like predict the returns. So say like whether it can be useful if you're like forecasting price of electricity, for instance, or something like that. But it's always like a research question, and it's really hard to say upfront what's useful and what's not. Generally, these firms, they tend to acquire a lot of data or just like record it themselves, and then they try to figure it out. So it's if it's like proper quant trading, you build things automatically, and you have a lot of compute power. So it's not very it should not be very hard for you to like test different data sets. That's actually why you like hire quants. You get all these compute resources, and that's sort of like what everyone is doing, pretty much trying to find what's relevant to improve my forecast accuracy on a particular thing.
Cool, thanks.
You had a slide with the job descriptions, and one of the roles was quantitative trader. From this description, it looks like it's so easy to automate this role. Is it the case? Like, what parts of it cannot be replaced with AI or automated?
Yeah, very good question, actually. In some of the top firms, actually there is no such role as like a quant trader, because it has already been automated. Mm-hmm. Basically, in those firms, you try to build like a perfect research environment where everything works seamlessly, because you know that there will be no one like operating it, pretty much. They still kind of have some roles that they call them like trading analysts. So people who kind of monitor how the system is working, and they can press like a red button and like send an alert to like the quants and developers, but they don't have any decision power. Like they don't take positions or make trades based on their discretion or based on their like gut feeling or something. So yeah, that's true that like
so they're
firms,
like supervisors, right?
They're like sort of AI operators, you can say it like in that way. They are there to just in case something goes wrong, so you need to like act before you get bankrupt. Because there is actually like nice case study with a firm called Knight Capital. It was a few years back, but they basically went bankrupt in like 40 minutes. So like some trading algo just went crazy, and if you remember that order book, like with the spread, it was like just buying and selling at the same time. So just paying this spread like on these two transactions and doing so very quickly, and like basically it took like 40 minutes for the firm to lose like $500 million and like having to get bankrupt and stuff. So you do need probably someone to supervise it, but not necessarily someone who takes decisions on the spot.
Yeah, thank you.
Okay, can we keep final question? Probably like let's make a break because we're gonna be out of time.
So yeah, thank you for the talk. And first of all, can you show the latency slide?
Sorry, which slide?
The one with 3 microseconds.
This one.
So yeah, 3 microseconds is like 1 kilometer of their light travel. So it is not like very much for exchange between the 2 different stock markets, or is that like their actual like time to react, not their time between their time steps?
Yeah, like I don't really know exactly how they calculated it. If you're really interested, I would recommend to check the link later. But I believe that it's not just about kind of the light travel through like the physical length, but you still have to do some calculations, right?
Yeah,
So,
yeah. But it's like you need to subtract the light travel time from your calculations time.
Yeah. I mean, it might take a couple of microseconds for you to calculate, I guess.
Yeah. Okay, and just continue with the quantitative things. They're transformers. They're very data hungry, and how do you tackle it?
Yeah, actually, like as you can imagine, like this thing generates like petabytes of data on a day-to-day basis. So that's why actually in this industry it's not uncommon to like work with these like advanced models that are very data hungry. But obviously, yeah, you kind of many of these events are just noise, so you have to like somehow deal with it and somehow make your data hungry model to like figure out what's important and what's not. Because yeah, if just garbage in, garbage out, the whole principle sort of holds here. But yeah, it's essentially like what everyone is kind of trying to do. You have petabytes of data. It's your call how to work with it, what models to check. But it's a nice environment to be working with these models because essentially you have a lot of data to work with.
Yeah, thank you.
Okay, let's probably somebody wanted like have a question.
Last question, yes.
Oh, yeah, so a bit related to what's an important feature, is there a name for the specialism or subspecialism of people who try different potential sources of information and work out whether they're useful features? So, I was thinking if there's a company, they're about to, they know inside that there's going to be a merger, or they know that there's this sort of information. People outside don't know, but there might be signals in terms of their purchase behavior. There might be different forms of social media interaction and expression in terms of employees. There might be hotels or conference rooms that are booked differently if it's between 2 particular companies. There might be all kinds of things that might signal that there's slightly more information available internally than there is externally that could produce an edge. Is there a sort of name for that specialty?
Like insider trading?
No, it's sort of, it's the idea of, can you use some of this information to get as if insider information in a consistent way? So if you know that a whole load of GPUs are being bought, if you know that various sites are being looked at, and you're thinking, and they're close to water or they're close to this, working out, well, what could that mean, and what could that mean in terms of how things are priced at the moment and where we think they ought to be priced.
Right. Yeah, I believe you're talking about alternative data, probably. So, like in these firms, it's quite common. It's a quite common term. So all the data that is basically not like price volume data that you can see in the exchange, it's called alternative data. So things like also like, say, hedge funds, they monitor how many parking spots are occupied in like for Walmart stores, for instance, and then they try to like think whether the price of stock will go up or down, because say if it's occupied, then they sell more, and then they will the earnings report will be better. So yeah, there's definitely research going on in that direction, but I would say on the more like longer term basis. So it's not something that you usually decide on in like a second. It's more like days or even quarters.
Yeah. Okay. Cool.
Okay, guys, let's stop here because we're going to be around out of time. Can you just...
Cool. Thanks everyone.
Thank you.